Well, hello everyone, welcome to the Market Recap. I'm Jake Pelly, and today is October 3rd, 2018. As always, here's our fun disclaimer. As this is being recorded, you can always view it at your leisure once I post the replay. So how's everyone doing today? I'm doing pretty good. Not gonna lie, I'm pretty tired. New babies are always trying the first month, and as you can tell from the background noise, my kids are loud as always. Now with 33% more louder, with one more kid added. The market overall has been on a pretty good tear to the upside. The Dow Jones was up today, the Nasdaq was up today, and the S&P 500 eked out a small gain, but pretty much flat for the day at up 2 points. You can see that banks and Facebook and Google were leading the way today. Facebook being hit very hard recently on news for regulations on bots and how advertising works for social media platforms. So not great for those two spaces, but it looks like they got a little bit of a retracement here. Services were down a little bit. Walmart was down. Your Comcast is down. So is your Disney. And so is consumer discretionaries outside of Apple. Apple actually having a nice little rise here recently. While I've been gone, we've got a new NAFTA. You can't see the new quotations I'm making, but Canada finally came to the trade table and they did make a deal. Good for the overall markets. It does look like the tariff talks are backing down just a little bit, but we'll have to see going into next week as there's currently a holiday in China, I do believe. And then going after that, we should see a return to the talks, what happened there. So we did have some economic news came out today. We did have Powell did come talk today for the second time. He's talked recently. As you can see here, he's talked twice this week. Spoke yesterday. Spoke today, and he had a little bit of a hawkish tone. He said that they want to move above the neutral rate for bonds, meaning that he wants to see bonds moving above the 2 to 3% back to about the 4 or 5%, which is historically the average yield for bonds, and that would get investors excited for our debt. Now remember, the rest of the world is pretty close to negative bonds right now, negative yield on their bonds. So Japan's still there, Germany's still there, the EU is trying to get out of there, but there's still negative bonds around there, and it's really hurting their economy, centrally wise. And so there is kind of a roll from those areas of the world back to the United States because we are actually yielding positive bonds, and it's a pretty safe area. So we are seeing, with Jerome Powell talking about this, we are seeing some liquidity crunch going across the world. The emerging markets still look pretty ugly. They did get a little reprieve with the dollar moved down, and now the dollar is moving back up here, so you should see more talks with the emerging markets continue to get crunched here. With liquidity starting to dry up a bit, the free credit kind of drying up here, and central banks looking to potentially raise rates, countries that have been living off cheap credit or seeing a flight to the emerging markets are going to start looking very weak here, so be kind of careful in that space. Think about it as a stress ball. As you squeeze a stress ball, it moves out of the cracks in your fingers, and those cracks would be the emerging markets. So as you squeeze rates more and more and more and more and more, and they get less and less and less yield, you're pushing people into those cracks, or also known as alternative investing. And as that stress ball is getting its grip lightened, and those cracks are now starting to go away, and we're seeing a reinflation of bond yields, you're going to see a flight from those areas because they have a lot of dollar-denominated debt, and with yield moving up, they're going to have to pay back more in that interest rate. So not looking good for the emerging market area if that is the case. So keep that in mind. Now there are some quality areas that thank you very much, Bob B, and it's good to be back. So there's going to be some good stocks to look in the emerging markets, but as a whole, it's probably going to continue to look very ugly here. The S&P 500 is outperforming the overall global markets. The Hang Seng and the stocks and DAX are still very ugly here, and they're probably going to continue to be. Italy's having its own type of crisis, so is Greece, so is Macedonia. It's going to be continuing to be a little problem here if the dollar continues to strengthen, so keep that in mind. Now if we look at volume today on the NYSE, you can see that volume was a little bit above average from the NYSE or the NASDAQ, not the NASDAQ composite, NYSE composite. So not too bad above the 700 million that we have been seeing. The NASDAQ though, look at that, 300 billion today. That is a whole third higher than it normally is. Usually it's 2 billion is considered very good volume, and we hit 3 today. So very, very interesting. And you can see tech was not within one of the strong or weak indicators today. So keep a close eye on that. It's very interesting. The NASDAQ kind of still moving up here. Now the advanced decliners, now the advanced are people are moving up, decliners are people moving down. It's still pretty positive. The NASDAQ is still showing a lot more advancers and decliners, so not too bad there. The NYSE was pretty flat. You can see that was pretty close. You might be saying, well, Jake, that's 1,500 over 1,469. Yeah, but it's 3,000 shares inside that composite. So this back number here is a little bit more of a margin of error. So, as you can see right here, Italy reported cut its budget deficit for 2020 and 2021. Credit pressure from the EU. Italy's going to continue to have pressure here. Any country that has an aging population is going to have a problem. Italy, Greece, Germany, Spain, all are getting a little bit older in years here, and they're going to start getting annuitized in their annuities. Pensions are going to start drawing their pensions, and it's going to cause a problem for their economies as jobs are going away because of automation too. They have a big growth. They did have a big surge of population here in the last 20 years, and it's going to cause a problem for them because a lot of that surge that they came from is not quite as healthy financially as the older generation. So very interesting to see this. Italy and Greece are going to continue to be a problem in that economic space. Better than expected economic data. You can see the employment change report right there. Not too bad. ISM manufacturing, pretty good. Anything above 60 is considered good, and we got 61, so not too bad. Heavily outweighted financial sector outperforms as yield raises across the curve, with the benchmark touching the highest in 7 years. So again, pretty good economic data, but not great for the overall market. You can see here that finally we crossed above that 3% steadily on yield on the 10-year. Now, once it starts getting above the 3%, it's going to see the stock market getting a little shaky once that 3% holds steady, because you're going to see a rolling of a little bit more risk assets into the safer assets of bonds. Why would I risk being in this market that's been up for the past 8 years, or since 2011, if I don't have to worry about them starting to have declining sales, their EPS starts to move down? I can just move back to the safety of bonds, which the Fed wants to raise. So just keep that in mind. With that being said, let's go take a look at the indexes. Let's go look at our commodities, and let's go take a look at our VIX, our bonds, and any stock you might want to look at for just a little bit, and then we'll wrap for the day, because I promised my wife I'd give her a nap before bedtime. So looking at the overall S&P 500, you can see that we did break above this channel that we were looking at for quite some time, made an all-time high at the 293, came back down. Now we are basing right here, so keep a close eye on this 291. If the 291 breaks, probably going to see a movement back down to the 289. We are moving into earnings, and this is one of the biggest guidance cut earnings that's been around for quite some time. So companies are pretty much flying to cut their earnings guidance just to make it so they have better EPS numbers. It was the same as last earnings and the earnings before that, so they can beat these EPS numbers. Now remember, the second quarter saw the largest inflow of share buybacks ever at $400 billion in share buybacks. A lot of the movement in this market is from those share buybacks. So what does that mean? That means that with less liquidity, if stocks start performing, if the company starts producing less and less revenue, it's going to look bad on those EPS numbers. Less liquidity means less shares dilute, meaning that those EPS numbers are going to have to come in a little bit more. Byproduct of share buybacks. So share buybacks are still happening, but they might start to slow down here with interest rates being comparable. So keep that in mind. Now, if we do cross above the 293, we could be moving back above to the new 294 here. The Bollinger Bands do support this level, so keep a close eye in here. We are kind of compressing in the Bollinger Bands. That tells us sideways action. Volume is starting to kind of drop off here. Also, the histogram, the MACD, Not really moving much here. Flat. Same with the moving average. Same with stochastics. So that's what you want to watch here. Next up, let's go take a look at the NASDAQ. QQQ. The NASDAQ is doing pretty good. Still in this upward channel here. Still holding. But we are kind of basing right here in this channel between the 185 and the 187. Right there. So if we hold this range, it could be good for the overall market. If it does dip down, keep a look for the dip right here to the 183. Now the big companies are going to be reporting earnings in the NASDAQ and the S&P 500. I do believe we have Apple this month in October. The end of the month there. We have Amazon. Amazon usually reports on the Thursday too. So right there, Amazon's reporting on the 25th. See that? Amazon on a Thursday. Google usually reports with them on that Thursday, though they've been known to move it to a Tuesday. So that wouldn't be surprised if I see it on the 23rd. Yeah, 25th there. So we are seeing the big movers starting to come into play here. Typically, this is when we see implied volatility start to ramp up too. Facebook has had a lot of implied volatility here as the advertising space and the controlling of bots has really been cracked down in social media. Not good for Facebook. So the stock is continuing to kind of base lower, and I'd be surprised if it moved back above this 171 before earnings here. So typically the MO for Facebook about 30 days before its earnings is to move sideways. I mean, you can see it right here. Kind of moves sideways. Earnings, it moved up. Kind of moves sideways. So it's not abnormal to see these kind of ramps into it. So just keep that in mind. Facebook's been very volatile. I do think this is still going to be the weakest of the fangs going into next earnings. So keep that in mind. I think Facebook and Google are going to continue to be the weakest ones. I don't see social media getting stronger as more regulations start cracking down on these big unregulated markets. I do think the Wild West days is starting to see some development. The railroad tracks have been laid, and the city folk are starting to come into the old saloon, and they're starting to order drinks a little bit more consistently, and that means you can't water them down as much. So that's what that means for these two. So FANGs are going to start reporting in. Microsoft as well. Microsoft usually reports a little bit sooner than the rest of them, but it looks like it's going to be on the 25th as well. Now this is expected earnings too. This is not the official date yet. So Microsoft, Apple, Amazon, Google have all been kind of propping this market up, and it does look like it's continuing to do so. Alright, so keep that in mind. It does look like it's kind of range bound. Next up, let's go take a look at the Russell. Now the Russell has been kind of interesting here because I can't look it up right here, but I can look at the IWM. So looking at the IWM, it has come down really heavily here. Now why has it come down here? Well, it's because, first of all, the IWM has been kind of the leader this year in upward movement, and now it's kind of coming down. Why is that? Well, we are seeing that negotiations for trade talks are happening. So usually companies that do very well when tariffs increase, when trade disruption happens, domestic companies will typically perform very well because now they can sell their services at a premium. Now we have a trade agreement with Mexico and Canada that's going to get ratified by Congress potentially. And so, what does that mean? Well, it means that they no longer can sell their goods at a premium, so that means they should be coming down a little bit. Now they have some competition, so supply and demand dictates that their prices should go down, meaning that they should have a little bit less growth in their earnings. Now, we still have trade talks with China, and so it's probably going to be propped up a little bit more, but if those trade talks for China come through, I wouldn't be too surprised if the Russell continues to move down here at the 163. 162 level. So keep that in mind. It did break an important area at the 168 and kind of just cratered that. We might see a little bit of a bounce here as this is pretty oversold, but what concerns me is volume is picking up to the downside. So this tells us because the third quarter is ending and we're going into the fourth quarter, we are seeing a little bit of rotation into more global stocks as opposed to more domestic stocks. So that's something you want to keep in mind for the Russell. Let's look in here. Intel. United, I think that's United Health Corporation and Square. Alright. So let's go look at those really quickly here. Now first up, let's go take a look at Intel. Now AMD has been getting kind of whacked here recently, and it'll be interesting to see if this is an inverse of what's happened with AMD. So the last couple days, we've seen a nice upward movement in Intel. Let's go look at AMD. You should see the inverse there. You should see some downward action in Intel since the 27th. So 27th, downward movement here. A little too much exuberance in AMD over Intel. Intel is still around here, and the company is still making money. Nice little pop here, and you could be seeing a rotation from AMD stock back to Intel. Not bad. Volume is actually picking up here, which is a really good sign for it. It's moving up on volume. It's still in this downward range, and it broke out of that range, which is a good sign for it. It broke not only here, but it broke above here. So it wasn't a consolidating triangle, and it broke out on volume. It's a good sign for a potential continued rise, though I do believe Intel does have earnings this month as well. Yeah, on the 25th. Wow, there's a lot of stocks reporting on the 25th. Potentially Microsoft, Amazon, Google, and Intel. That's going to be a very volatile day. So keep that in mind. It does have a dividend payout there. The volume picking up is really interesting. The volume picking up outside the consolidating triangle tells us that it does bode well for the stock. Typically, breakouts and patterns on volume are typically seen as a bullish sign or a bearish sign. Now we broke out of a consolidating downward triangle on volume, and the volume stayed there. If we go look at the FinViz for average volume on Intel, it should tell us that we are seeing above average volume for the stock. And there you go right there, above average volume. So that's usually a good sign. The momentum is slowing down a little bit, and so that would be the one thing concerning me, is the slowing down of momentum. We might start to chop out here. If we go look at a 2-minute chart, yeah, it is starting to chop out here. So keep a watch of the 48.55 level. If it does dip below here, it does look like we could potentially start chopping out around to 48 and 49. And you might be saying, Jake, why are you bringing up volume a lot? Well, I've been doing a lot of mentorships lately where a lot of people have some basic brokers, usually Robinhood. And Robinhood does allow you to trade some stuff, but usually you don't have this really advanced charting like you do in Thinkorswim or Tastyworks or Option House. And so we're pretty much, I brought it back down to the basics. And what do you really need for the basics of trading? You need price and volume. And usually you can trade off just those two. And just to show an example of it, I did it this year on AMD. I bought the stock when it broke out at 26 because it broke out on volume, and it continued to kind of move out here. Volume kind of stayed up. You can see now volume did decline a little bit, but volume picked up. I bought it, sold a covered call, and held it, and it's been doing pretty good since I've been doing that trade, and then I got out of it. I did close my AMD positions the other day because volume is starting to decline here on a steady basis. So I did get out of it, and implied volatility started to chop around a little bit, so waiting on AMD. I did the same for TNDM as well, just to show breakouts on volume typically run. And I believe I actually bought the stock right. Let's make myself honest. When I bought the stock. Market watch here. AMD. Let's go back 15 days. Here we go. And then I sold, you can see here, I did buy some calls. Buy, sold, sold. So I made a nice little profit there on AMD, just off those two things alone. Let's go back 30 days. Here we go. Just to show you that I actually did it. I put money where my mouth is. I bought the stock on 9/5. So I bought it right here because it broke out, and it typically will rise off that. So just to show you that I did it, I actually traded just off volume. Plus the implied volatility is pretty good. So next up, let's go take a look at UNH. Ooh, UNH, nice little rise here. Nice little upward wedge in UNH. Still holding its channel. I can draw this channel back even further. This is a very healthy channel. Look at this. Wow. You can draw this channel almost all the way back into March of this year. There we go. A little bit better. Nice little rounding down, moving up. What is UNH? UNH, I believe, is United Health Corporation. Yeah, there it is. UNH, I believe, is also a Dow stock, or maybe that's UTX. Yeah, it's UTX I'm thinking about. Okay. I always get UNH and UTX confused. It trades in the NYSE. Okay, alright. Not bad. Nice little rounding here. It does look like it's continuing to move up in its channel when it's its earnings, because that's relevant to this quarter, and it's going to be in 13 days. Does implied volatility ramp up into its earnings? It doesn't look like it follows implied volatility waves here. Looks like it kind of holds kind of flat overall. Sorry about that. As I said, it's gonna get noisy. Not bad. What are you looking to do in UNH? This doesn't look like a bad little range it's in. If it does kind of round here back to its channel, I'd keep a look at the 267. 2-minute chart. Yeah, shows some chop here. Keep a watch to the 269. If it does break, as you can see right there, it's kind of held that level pretty steadily the last 2 days. You can see it bounced off it, moved back down, bounced off it, finally pierced above it, moved back down, pierced above here, and then it kind of moved back down. So it does look like it's kind of magneted towards the 297 handle. So keep a close eye right here. It does look like it's having a hard time staying above 271. So you do have about a $3 channel there in UNH. Implied volatility, not too bad, 29%. Actual implied volatility is 20. Might not be bad for a covered call if you're slightly bullish on it. Volume on it's 3 million, so it's a little bit light there. Seasonality wise, not bad. The volume's actually picking up a little bit there, but just slightly. So not bad for UNH. If you were to look at maybe selling a covered call, you could actually sell it all the way to 280, though it is a $280 share company, so that's a lot of money just to hold up for $100 in covered calls here. The put side, not bad premium on the put side either, so you could look there. I mean, 260, the 260, if you already own 100 shares, the 280, 260 straddle with owning long shares doesn't look too bad. You'd be covered to the upside, and to the downside you could look at the 260, which the 260 puts us right about here to the down in this channel. Right here, it does put it, it would dip us back down. It would break this upward channel that it has been in, so keep that in mind. 267. Okay. Yeah, not bad. You could potentially sell like a 275 and maybe put a collar on it if you want it 265. So there is optionability to play right here is what I'm getting at for 19%. 19% is pretty light. You want to see at least 20 to 30%. Yeah, that is pretty light implied volatility. Not a big significant Vega risk, though, for UNH. Next up, let's go take a look at Squarespace. Those are the ranges I'd look at for United Health Corporation. Looking at Squarespace, the stock has been very hot lately. I know a ton of people trading this stock. It has turned into what MU was earlier this year, and absolutely to a rise here. Look at this. I know a lot of independent contractors that use Squarespace to get paid over PayPal, and it's looking like it's going to continue to rise. This rounding has me a little concerned here. Typically when you see this, you want it to hold above this where it started the round. So 296, I'd keep a close eye on that. If it does dip down below here, this candlestick will be kind of a guidance to 289. Volume is starting to come down a little bit. We are a little bit overbought. We are seeing some rounding histogram in the MACD. Be careful on Square. It does look like it might be potentially rounding here. I would look for an order entry if it can hold this 90.55. If we go look at the end of the day here, you can see that there was potentially some weakness in the end of the day. Oh, early on it was the weak. No, it rounded down. Yeah. So keep a watch tomorrow for the 90s. There we go, right here. Potential breakup. I wonder why it's not letting me do this. There we go. Right here is where you want to look for potential breakup and a sustaining of that move. 40% implied volatility tells us that there is some good implied volatility to extract here above 51% too. Tells us there's some option play to do here. Now next up, let's go take a look at the DXY. Now tomorrow I will be doing my normal market portfolio growth meetup. So keep that in mind. Now looking at the dollar continued to rise here. Why is that? Well, the Federal Reserve wants to tighten liquidity, meaning they want less dollars in circulation. That is one of the two levers that the Fed has to control liquidity. They can flood the market with dollars. They can take dollars out of circulation. They can increase interest rates on certain bonds, and they can decrease interest rates on certain bonds. Those are the levers that they use to kind of control the market, and they can also do big bond buying purchases, which is the third pillar that really wasn't supposed to be there, but Greenspan and Bernanke saw that one to put through. With that being said, with the dollar continuing to strengthen here, it's interesting to see that gold, it's holding a nice range. How am I doing in time? Doing pretty good. Okay. Let's open up here. There we go, there we go, there we go, there we go. Gold is back in this range here. Now remember, the dollar was a lot weaker when it was right here. It did gap up and it held, meaning a big buyer stepped in here. The dollar strengthened and the gold gapped up. Typically that doesn't happen. So keep that in mind. It might not be the best time to buy gold right now, but keep a close eye on the commodity. Seasonality-wise, October is a little bit wonky. As you can see right here. There we go. Here, gold. Typically 1, 2, 3, 4, 5, 6, 7, 8. 1, 2, 3, 4, 5 in the past 8 years have been down in gold. So keep that in mind in October. With the dollar continuing to potentially strengthen here, I would keep a close eye on this precious metal. It looks strong in the channel right now, but this move might be because people are position sizing right now, being at the end of the quarter. So keep that in mind. USO is continuing to rise here with the dollar. Typically that's seen as a bad sign, because not only is it getting more expensive to borrow because the dollar is going up and interest rates are going up, but oil is also building up, as you can see right here. That's a pretty big growth in storage right here. In the previous month, not too big. This one right here, that's a little bit of noise. 8 million barrels is something big to watch. Now we are below where we were this time a year ago. Not too bad. Oil is continuing to rise here. Typically these two don't rise together. The dollar and oil don't typically continue to move up. Usually when the dollar moves up, oil comes down. We are moving into a time when oil switches over from its winter blend or summer blends into its winter blends. They're a lot easier to produce and a lot more profitable for oil companies. This is a pretty big move in oil. We haven't seen this move in quite some time. If we go through a 3-year chart here, you can see it has not been up this high in a while. Now we actually have to go to a weekly chart so you can see when is the last time oil has been this high. Right here. Oh, actually I have to go to monthly. The last time that oil has been this high was in 2015. So be kind of careful here, because last time it was at this point, it kind of dipped down. Now, it has the potential to rise to 20 if it does break the 15-16 handle here. So keep that in mind for oil. Usually we don't see this type of rise. You know, what's interesting is in 2015 is the last time that we saw the movement down in bonds where we're currently sitting at. It's interesting. Bonds have gone up in yield and oil has risen. Really interesting. Now, it's not causation, cause correlation. It's just interesting to see that 2015 saw a big dip in bonds and big dip in oil. Bonds are continuing to kind of move down here as yield is expected to continue to rise to the Federal Reserve. What does that mean? Well, if you're long TLT, I'd be careful here. We did violate an important area of support in the monthlies. In the weeklies, we violated an important area of support, and we are continuing to move down. It is Wednesday. We didn't move down below this 16 handle that we've held almost all year. This area has been a clear area of support, and we broke down it and almost touched the 14 handle. On the daily here, you can see the chart even looks uglier than that, and we moved down. Near the end of the time of the day, we reversed a little bit, but it still looks pretty ugly here. Bonds are going to continue to do poorly. Not in price, but in yield. Yield will do a lot better. Bonds will do poorly in price, but yield will move up here. If the Fed wants to continue to normalize rates above the neutral level being usually the price of inflation, that means that the price of the bonds are going to go down and yield's going to go up. Usually tells us to be bearish on bonds. Now, it is a little bit oversold here, and we might see fixed income come in near the first, second week of October once the quarter starts and buy some bonds. So you might get a nice little pop from that. After that happens, bonds will most likely be continuing to move down. The next target I have for bonds is all the way down into the 2015 levels right here, down to 110. So be very careful. There's no real area of support until it moves down from there. Look at that. It goes back very far since the last time this dip happened. Now, it might be 2012, or sorry, 1012 here. Might be in the next area, but the strongest area supports the 110 area. So keep that in mind. If you are bullish on bonds right now, understand it's probably going to continue to be weak for the rest of this year. Outside of this retracement that's a little bit overdoing it, and fixed income might step in and buy some. Once it allows me to go back over here. The range that we've been in bonds, typically whenever it touches this 116, it bounces back to the 118. It will cross above here for a little bit, maybe sometimes a month, but it will always come back down to this 118. Now it's dipped even further, so be very careful. With that being said, though, this has been your market recap. I'm Jake Pelly from Wall Street IO. I'm gonna go give my wife a nap so she doesn't get angry with me. And as always, from Wall Street IO, I'll see everyone tomorrow at the normal meetup on Thursday. Thanks for your questions and have a good night.